Welcome back, subscribers. This is Johnny Crypto, and today is just a very quick video on margin. Should you use it? Should you not use it? What are my 2 cents? So let's just get right into it. My 2 cents is generally the general population are bad with money. So good for you for wanting to invest. Margin is essentially like a credit card for buying more stocks. So Robinhood says that they'll give you $1,000 a margin for $5 a month. So you can purchase $1,000 basically on credit of whatever you want. You just pay a monthly fee for that. All right, and then they have an interest rate of 5% or so. And they say they give you a bunch of benefits for it, as far as they're going to come out with this level 2 marketing data. I have no idea what that is. It's going to be more charts. Personally, I feel like you can do a better job on TradingView just with a free account. So we'll see what the marketing data is. I know that they've got candlesticks on Robinhood. It's still... It's just a chart. It doesn't have a whole lot of technical analysis or fundamental analysis, anything to do with that stuff. They've got bigger initial deposits. It's just going to clear same day. I haven't had any problem just with my free account. And then they say that they're going to have professional research available to you. That would be the only reason why this to me would be worth $5, would be that extra research data, because for fundamental analysis, that is great for making a decision. On top of that, I don't think it's a good idea, especially for a beginner investor, because it's basically buying something almost on credit. And if the stock ends up falling substantially, well, you might have to be called, a margin call where the broker comes to you and you have to come up with a substantial amount of cash. And just giving you a example, let's just say you had $10,000 to invest, and with margin, let's say they'll give you 10,000 as well. Okay, this is just round numbers so that you guys can use it. I'll put the chart up there as well. So let's just say stock is $100, right? So initial investment, $10,000. If you're on margin, you have $20,000, so you could buy 200 shares, as opposed to just without margin, you can only buy 100 shares. And then the chart goes on to say, hey, it drops to $50 after 6 months. Well, if you're the guy that just paid cash, well, you lost $5,000, 50% of your investment. So you're only out $5,000. So return on investment is 50%. On the margin, however, you're out $10,000 because you bought twice as many shares, plus they're charging you 8.5% interest rate on that money. So your total return on investment is a negative 104.25%, and it'll just compound and compound. I know Robinhood says that they've got a 5% for $1,000, but they will give you a fixed interest rate if you decide to margin more than just $1,000. They don't tell you what that interest rate is, so is it going to be close to that 8%? Well, typically I've seen brokers anywhere between the 6 to 10% on margin, and it's just like a credit card for them. So my personal opinion is stay away from it. If you do have margin and you're a fairly decent trader, well, please comment in the comment section down below. Let me know how it works out for you, and I'll join the conversation. Thanks, guys. This is Johnny Crypto, signing off.